Good afternoon and welcome to HYCM's webinar, FX Week Ahead Live Market Analysis with myself, Giles Coughlin. I'm just going to wait a moment for people to sign in and give folks a chance to sign in. Hi Ravi, Van, Hashik, good to see you guys. If you could just let me know that you can hear me okay, that would be super, just so I know that the volume is coming out all right. If you could just type in the question panel on the bottom right, that would be really good. So I know that you can all hear me okay. I think it's okay. My main screen is showing, I can see that. And I'm getting some response from my audio. So I take it that you can all hear me. Just waiting a moment for other folks to come in. Hi Nadir, hi Lillian, hi Van, good to have you guys. Hi Raj, yeah, thank you for typing in, that's great, lovely. I can hear that you can hear me okay. Well, we've got a really interesting session coming up. We've had a lot of market activity, particularly on the last day of last week. So I'm looking forward to taking you guys through what's been happening. And also there's been a lot of talk about the an inverted yield curve. So I'm going to spend some of the time during this webinar to explain what that inverted yield curve means and why it matters to us as FX traders. So we've got a little bit of extra value today, so that should help us in all that we're doing. Just check you can still see me okay. Yeah, that's great. Just put my power cable in. Also, just want to make it clear that as we're looking at different, as we're looking at different trade setups, just to make it clear that these are not trade recommendations. The whole idea of what we're doing in this webinar is all to do with education. So even though we're going to be looking at different positions, different entries and exits, none of this is trade recommendation. It's all simply just education to help you see sensible places where you could enter the market yourself. Okay, so that's just to make that clear. This is the week ahead look, and before we look ahead, what we need to do is we need to look back. So let's look back to last week, and don't forget, if you haven't got any questions, just type them in the panel. You can also email me at giles.coughlin@hycm.com, and anything that you want covered, just email me there and we can look at doing that. Okay, the first thing to note from last week is the Federal Reserve, and just to remind those of you who don't know, the Federal Reserve is the US central bank, and it's the most influential central bank in the whole world. And essentially, what the US central bank does, the rest of the world tends to follow. So the Federal Reserve, they kept their interest rate unchanged at 2.25 to 2.5%. That was a unanimous decision, and that was expected. However, what was not expected was this sentence here. You see the Fed dot plots show median forecast is for no hikes in 2019 and one in 2020. So how that surprised the market. The dot plot was aimed, the purpose of it was to show the market the intended path of US bank rate path. Okay, are they going to be raising? Are they cutting? What are they expecting? So the dot plot is to say that the dot plot, so I'm just looking at some Brexit headlines coming out, which is always, seems to be that always when I do this webinar, we get some interesting Brexit headlines come out, but we'll cover that. But this was the move from the Federal Reserve, and they're forecasting no rate hikes in 2019. That's the most important part to get your head round. And so this resulted in some US dollar weakness towards the end of last week. That reversed on Friday. I want to explain why. But the market is generally thinking, okay, the Federal Reserve is now firmly in wait and see mode. They see weaker term economic growth. They're expecting less inflation. So the Federal Reserve says, look, we're in a wait and see mode, and we're not expecting to be hiking rates at the same path that we were expecting. So that's a significant shift. And as a result of this change in forward guidance, the US dollar was sold off on this data. Okay, the dollar index was sold off. and was moving away from a key 100 moving average on the daily chart on this information. Okay, so that's one thing to log. Okay, the Federal Reserve is more patient. They are looking to see incoming data decide on the path of interest rates. At the moment, they're thinking we're at the right level. We're pretty much at neutral. So that means all the data that's coming out for the US is going to be factoring into the bank's decision making on future interest rates. So that means US data is becoming increasingly important. Okay, so just to be aware of that, particularly looking at inflation as a key indicator, and GDP growth. Now, EU leaders, last week, they extended the Brexit deadline. Theresa May had another disastrous week, and Theresa May had to go to Brussels. And what the EU leaders have said is that the UK has until May 22nd for Theresa May's deals to be accepted. Okay, she's got until May 22nd. If the Theresa May's deal is accepted in the UK Parliament, that will mean that Britain can leave the EU at May 22nd. So that's the ideal scenario for the EU. It's probably the ideal scenario for the UK. However, if May deals is rejected, then the UK will have until April 12 to find an alternative way forward. So that means looking at the future path for the pound, we see that there's two different alternative routes. May 22nd, if Theresa May's deal accepted. And why I was momentarily distracted during the webinar was the news has come out that there is now going to be probably a Brexit vote, on a meaningful vote tomorrow, okay, in the UK Parliament. So that is why there's been a sudden pop in the pound. So if we just have a look at the pound, we'll see that there's been a sudden pop in the pound, and that has been on the news that Theresa May may well be holding another meaningful vote on Tuesday. So, okay, so if that meaningful vote is accepted, then Britain will be leaving the European Union with a deal. Okay, so we need to start thinking to ourselves as we look at that. Okay, what would that mean in terms of price? Now, looking at the price charts, this is a pound US dollar weekly pair. You can see that, you know, again, this is not trading advice, it's education. But look, if you took the view that Theresa May deals will be accepted, then reasonably, a next reasonable target would be about 1.36, 1.37, just underneath this 200 exponential moving average. So 1.36, you know, 14, okay? 1.3600 would be a good target. And stops could be placed below the 50 exponential moving average, say at 1.3036. Let's just check some other price charts. So let's look at pivot points for the pound. I'm just going to have a look at this, and I'm just going to do a screenshot for us on. We'll look at the weekly chart. Okay. So looking at the weekly chart, we can see some key pivot points. Okay, so here we go. Now here looking at the weekly chart on the pounds, we've got the pivot points. We're at a key pivot point on the weekly chart, which is here about 1.320, okay, which is the same as the 100 exponential moving average level. So a break above these highs, and then you could see up to 1.3839 is the next pivot point. But clearly, the first target would be the 200 exponential moving average. So there's potential for a good trade, and I know Morgan Stanley the bank have been recommending this trade. Not saying that you know, you should do it, but saying that if you took the view that Britain is going to secure a deal, that May's deal will be accepted, stops just underneath these lows with a target of 1.36 is not a bad option in terms of risk reward. So that's just pointing that out, that potential opportunity. Just popping that there. There we go. Okay. Now, The next thing is, this was the news that really hit badly on Friday. It took the market by surprise. It took a couple of my positions out when it came in. I was away from my desk, and it was Germany's manufacturing PMI data that came out. It hit 72-month low. And the manufacturing PMI, it was expected to be 48, it was 44.7. The French manufacturing PMI, that's the Purchasers Managers Index, that's kind of, a survey of the manufacturing conditions within the country. That was 49.8 versus 51.5. The French manufacturing PMI came out first. I saw that. I thought, okay, that's fine. And then the German manufacturing PMI came out, and the market sold off so heavily, I couldn't get out before my stops were hit. Again, not a big drama, because I believe in very strict risk management, so it wasn't anything to get worried about. But it was significant, and the market took this news very significantly. The euro sold off very heavily on the news, and the Scandinavian currency sold off heavily. I was looking to short US dollar, Norwegian kroner at the time, the US dollar NOK pair, because of the divergence between the two central banks. The Federal Reserve was getting more patient, whereas the Norwegian bank was slightly more hawkish than expected. So there was a divergence in central banks. So I was selling US dollar, Norwegian krone, and all the money that I'd made on the original move was then retraced. So I was pretty much flat on that currency pair because of this news here that came out out of the Eurozone. And the European equity markets sold off, energy markets sold off, and US dollar appreciated because the US dollar can be seen as a safe haven currency. Okay, so when the world is getting really spooked, the US dollar can be bought, and that was the dynamic that was going on with that Germany manufacturing slowdown. So this is a story that you need to be aware of. Okay. German manufacturing PMI hits a 72-month low. Big concerns that Eurozone growth is beginning to really enter the market, and that's just kind of a symptomatic factor of slowdown in China's growth, the general malaise about Brexit. It's more kind of gloom and doom, essentially. And Germany is particularly important for the Eurozone because it's the largest nation in the Eurozone. And so what's bad for Germany is bad for all of Europe. Okay, so that's why the Germany PMI had such a big impact. It's the largest and the leading nation in the Eurozone. So risk factors are building. Okay, US-China trade deal still not done. Brexit at critical point with chance of a hard Brexit. Chinese GDP slowing. Eurozone slowdown in growth. You can see how the market was becoming quite risk adverse. And you can see when you put these factors together that the market is very concerned. Now, that concern was also expressed via, this is something if you've been following the markets, you would have heard about this, which is lots of talk about the inverted yield curve. Now, I thought I'd just take a moment because this involves bonds, and bonds is one area that many beginner traders, it takes a while for them to get their head round. So this is particularly to do with the US bond market. So I wanted to just take a moment to just explain to you what the inverted yield curve is, first of all, and then I want to explain to you the significance, just so you can understand why the market focuses on it, because it is an extremely significant impact on the financial markets. First of all, just explain a yield curve. A yield curve is a line that plots the interest rates, or the yields, at a set point in time of bonds having equal credit quality but differing maturity dates. The most frequently reported yield curve compares the 3-month, 2-year, 5-year, 10-year, and 30-year US Treasury bond debt. So when you're looking at a yield curve, remember that it's a line plotting the different bond yields across the different length of those bonds. So a short bond is the 3-month one, and a long bond is a 30-year bond. A bond is very simply a loan. Now, you think about it, if you and I wanted to borrow some money, we might go to the bank, okay? And when a country wants to borrow money, it can't go to a bank because the amount of money that a nation wants is significant, and it's more significant than any one bank. So as a result, governments issue bonds. It's basically a loan. And traders, investors buy government bonds, and they buy these bonds, they give the loan to the government, and the incentive for the investor is you will get an interest rate or a yield on that bond. So for example, if you borrow a 10, if the US government borrows a 10-year bond, they'll say, well, we give you 2.3% a yield for that bond's length of time. So each year you get 2.3% of the amount we loan you, and that's usually paid twice a year. It's seen as very stable, obviously, and a government bond at the US government is seen as very stable. A bond out of the UK is seen as very, very stable because they're developed nations and they're able to service their debts and they reliably pay them. So you can see they're very popular. People are very happy to lend money. That is the sort of some of the principle behind it. Now, when it comes to the yield curve, there's three main types of yield curve. There's a steep yield curve, a flat, and inverted yield curve. So a picture paints 1,000 words with this. So we're going to get a normal yield curve. This is a normal yield curve. Now, having a little look, okay, to explain here. So here's 1 month, 6 month, 1 year, 3 year, 5 year, 7 year, and 10 year, and 30-year bonds. So remember, this is just the length of the loan. So for 1 month, that's lending money for 1 month, has a yield, just above naught. A 3-year yield bond in this chart has a yield of about 0.75%. But look, if you're prepared to lend someone money for 30 years, look on this chart, it's 3.916 yield. Okay, now this is a normal yield curve. Okay, it's a normal one, it's a steep one, because if you borrow money for a longer amount of time, you will get a higher return. And that makes sense, doesn't it? That's the normal situation, isn't it? Okay, the white line, this is a normal yield curve. This is known as a steep yield curve, but it's essentially the normal shape, which is lower for the short-term bonds, higher for the longer-term bonds. So under normal circumstances, a longer loan requires a higher return rate. That makes sense. Imagine if you said to me, right, we're going to loan some money and we're going to loan it for 30. We want to loan for 30 years. Then whoever we're taking the money off for 30 years say, well, in return for us loaning money for you for 30 years, we want a really good rate of return. We want 5, 6, 7% a year because we don't see our money for 30 years. So it makes sense. Oh, and if the loan is like for 1 year, then you might say, well, okay, we can lend you the money for 1 year, and we're happy to only take a low level of return. Does that make sense, guys? Could you just tell me in the question panel, is this making sense to you as we're going through this yield curve? Just come on, type a quick yes or no, and that'll help me to know how to time things. Yes, good. Good, Raj. Good, Olafemi. Good, Nadia. Thank you. Lovely. Right, coming on. Okay, great. Thanks, guys. That just helps me. It's quite complicated, the yield curve, particularly at first. So you getting it is a good encouragement for me. Right, so this is a steep yield curve. Now, you look at the next one, you see a flat yield curve. Now, you see that orange line is flat. It's because, look, a 10-year bond only yields marginally higher than the 3-year bond, okay? So here you can see that the yield curve is going flat. Okay, so in other words, saying that whether we lend it for 30 years, 5 years, 3 years, it's roughly the same yield. It's called a flat yield curve, okay? So the white one is a steep yield curve. That is seen as the ideal, okay? That's the normal yield curve. A flat yield curve is when things are starting to go out of kilter. Now, the worst scenario is the inverted yield curve. And this is the inverted yield curve here, look, where people are saying, look, to have a 6-month or a 1-month loan, we'll give, a 5% yield. We'll give more yield for a shorter loan than we will for a longer loan. Okay, that's an inversion. And it's a strange situation to be in. So why does that happen? Well, why it happens is investors buy long-term bonds out of fear. Okay, so when people are concerned about the economy, think about it with the US at the moment. There's been a slowdown in the Fed's path. There's a slowdown in growth. There's concerns about inflation. US-China deal hasn't been done. There's Brexit fears. There's Eurozone growth worries. There is, a whole catalogue of concerns. And so investors are thinking, well, hang on, we're worried about the state of the global economy. So we want to buy long-term bonds because we're scared. So we want to lock in that rate, and we want to take money out of equities because say you've got US equities, you might think, well, I'm concerned about the US economy, and if the US economy is going to be struggling, then US companies are going to be struggling, and if US companies are going to struggle, the share price is going to be falling, dividends are going to be falling. So if big investors, we want to take our money out of US equities and put them into bonds because bonds are more stable. So there's this big demand for long-term bonds. The government then make short-term bond yields higher to make them more attractive because people aren't interested in the short-term bonds. So a higher interest rate is given for the short-term bonds. In other words, this is a sign that investors are scared about the future path of the economies. Okay, and this is what's been happening. This is why the curve inverted on Friday, because the slowdown in Europe spooked investors, and so more money's been pushed into those bonds, and the short-term yields are increasing as incentive to try to get people to to borrow money at the short-term rates as everyone's flocking to the long-term rates. Now, the reason this is important is because it's a potential warning of a recession. Historically, the yield curve inverts as before a recession. So the yield curve is often seen as an accurate forecast of the turning points in the business cycle. 2005, 2006, 2007, 2008, the yield curve inverted, and it was the signal of an impending recession. That is why the market is focused on the yield curve, okay? That is why it's such a big deal. Now, there's a few concerns about the yield curve at the moment. Now, one of the concerns that I've heard is people are saying 10 years of quantitative easing has negated the inverted yield curve signal. Now, I don't actually buy that personally, in my opinion, but I'm saying it because it is a valid point that quantitative easing is a unique monetary policy by central banks that hasn't been used to this scale before. And as a consequence, does that mean, so much government debt being bought and sold on the market? Does that mean the inverted yield curve has the same impact? It's a question mark. Just be aware of the question. Now, if this yield curve remains inverted, expect talk of a recession to continue and look for more potential moves out of equities into bonds. Okay, that's what we'll see, because people will think, there's a school of investment thought that says you invest in either equities or you invest in bonds. Okay, so when the market is doing well, it's growth is coming, and optimistic about the national economies, you buy equities. Then when that business cycle has done its path, and then the Federal Reserve is now pausing interest rates, might be cutting the interest rates, well, you take your money out of equities and put them into bonds. So be aware of that dynamic going forward. Guys, I hope that's been helpful. Don't forget you can listen to this on record, and I would recommend you building on what I'm sharing with you here and going and having a look, have a look on different websites. Just Google inverted yield curve. What does it mean? Look at Bloomberg, look at CNBC, see what some analysts are saying. Increase your knowledge on this. I've tried to give you a good heads up and a good leg up on that. Okay, Brexit latest. This Brexit latest is constantly on the move. There's calls for May to resign over the weekend. She's resisted it so far, probably will for now. There's a new plans to be unveiled about Brexit. National UK paper The Sun announces that May will stand down once Brexit deal is approved. ECB Rain said Brexit is biggest threat to Eurozone, and ECB and Bank of England have plans to control currencies in the event of a no deal. Be aware of this. If there's a no deal, the ECB, the European Central Bank, and the Bank of England have plans. So just be aware of that. Okay, store that in the back of your mind. There is a plan. If there is a no-deal Brexit, that's going to affect the euro. It's going to affect the pound. You've been warned about it, so be aware of that. And a selection of amendments will be finalised tonight at 5 o'clock GMT time. Okay. Brexit tonight. They're going to be voting on Brexit on the Letwin A amendment, and that seeks to change the rules of Parliament in order to provide time for lawmakers to debate and hold indicative votes. It's been signed by more than 120 lawmakers. Now, this is going to be an important amendment. It'll be tonight, 5 o'clock GMT time. They're going to finally decide the amendment, so look out for what's happening here on the Letwin Amendment A. We also have headline risks with the pound. There's risks and there's opportunities. Consider using a Squawk for the headlines. Now, Rand Squawk do a free trial. Go to randsquawk.com. If you haven't used a Squawk, just go to them now, randsquawk.com, sign up to a free trial. It'll be worth it because for two reasons. One, you'll see how a Squawk can be useful for trading. Two, you will see how headlines really affect the pound at the moment. Okay, and you know, if you sign up for their full deal, you'll get the real time one. Okay, you get 2-week free trial. So you know, good time to use it, give you experience of it. Even if you don't take up the service, at least you've experienced what a Squawk service does. And Rand Squawk is, you know, it's worth it. It's a great service, and there's different types of service you can get. But even the lowest service they do is worth doing. Okay, it's a small fee. I mean, about £20, about $30–40 a month, and it's worth you having a look at. I'm just telling you that, guys, because it's helpful for you. Okay, risk is in the balance at the moment. Overnight Asian equities fell heavily. Now, this was the fallout from Friday. Hang Seng down 2%, Nikkei down 3%. Remember what I've told you before? When an equity market is down at 1%, take notice. So 3%, big drop. Hang Seng 2%, big drop. Shanghai 2%, nearly big drop. Okay. We had the Germany March business climate just lifted off the lows. Now, this is why risk is in the balance. Remember, it was German manufacturing data that put risk, you know, risk off into the market. Now, this business climate has just give it some recovery, right? We've got that slight recovery, was like off the lows, 99.6, and so European equity is slightly lower. E-mini is down 0.2%. 10-year yields are up 2 basis points to 2.46%. Gold is up. Obviously, gold was going to be bid on the risk environment. Equities are looking a little bit softer. You see the equities, they're down across the board. We've got the European equities marginally down, but still down. And bond yields are pointing to some minor recovery from Friday. So as a result, there's this mix, okay? Risk is in the balance. This was the German 10-year bonds. So they dropped very heavily on Friday. See this candle here? Big drop through that support 2 through support 3, and is now testing support 3 pivot point, but off the lows. Okay, so just to be aware of that. Risk is in the balance, so we don't know which way we're going to go. We had the bad data on Friday, slightly better data on Monday, so the market is in making your mind up time. Okay, so just to be aware of that. Now, looking at the FX week ahead, I'm just going to pull up the calendar for HYCM, so just bear with me for a second. I'll just get that up, and as I'm getting that up, we'll look at some events. There's not a lot of major calendar events that are expected this week, okay? But I'll just go through some of the events that we're looking at now. Going into, which day is it that we have? Yeah, Wednesday is the first major event that I'm really focusing on, is the interest rate decision out of New Zealand. Now, if you go to that, it is expected at 1 a.m. GMT time, okay, is the interest rate decision, and there's a press conference an hour afterwards. So remember, the press conference can affect the rate statement and interest rate decision. If the reaction is too much one way or the other, the press conference can, alter that. So be aware, there's kind of two opportunities there. There's this statement, and then there is the a press conference afterwards. Now, the last statement from the New Zealand was here. This is the last statement, which February 2019. The official cash rate remains at 1.75%. We expect to keep it level. The direction of our next move can be up or down, so remember that. And remember that they're talking here about a more pronounced global downturn could weigh on domestic demand, but inflation could rise faster if firms pass on cost increases to prices to a greater extent. We will keep the official cash rate at an expansionary level for a considerable period to contribute to maximizing sustainable employment and maintaining low and stable inflation. So this is the phrase, expansionary level for a considerable period to contribute to maximizing sustainable employment. Look for any adjustment in this policy assessment. If they indicate that they're going to be cutting interest rates, the New Zealand dollar will sell off. If they're indicating they're going to be raising interest rates, the New Zealand dollar will appreciate. So just be aware that's what you're looking for. That's the dynamic. You get two opportunities. The first opportunity is on the release. The second opportunity is trading the retrace after the release. Okay, so that's what you're looking for. You must bear in mind the press conference, because sometimes a central bank will reverse what's been said or enhance what's been said. Either way, don't just think, oh, I've got the rate statement, I put my position on, you know, I'll go back to bed or I'll go and walk the dog or whatever. No, think, okay, there's the initial move, but it could all reverse or change here at 2 a.m. So be aware of that. But Draghi speaking as well on Wednesday. It'll be interesting to see how he responds to the slowdown in German manufacturing. There'll be potentially some market moving data out of him. Then there's some GDP data. That's the final reading of the GDP data from the US. You know, you get the preliminary, and you get the final, and you get the actual. So this is the final reading. So you know, this is the least impact, but still it's going to be significant. So make sure you're around, or you take note of Thursday US GDP data. And then finally, the final data point that I'm really focusing on is the Canadian GDP data, which is coming out on the Friday. And we've got that coming out at, where is that? That is coming out, let me just check here. It's coming out at 12:30, Friday the 29th of March, okay? And for the monthly GDP for Canada, there's been 2 months of declines at minus 0.1% month-on-month growth. Now, growth is expected to return with a reading of plus 0.1% month-on-month. Bankers anticipating a pickup in growth starting in Q2 has an estimate of plus 2.1% for the year-on-year reading. So here we want to look for is if there's more declines, that's going to see further Canadian dollar weakness. Okay, so the bank is expecting a pickup, and if that pickup doesn't come, say you're getting minus 0.1, minus 0.2%, you'll get a sudden spike in the Canadian dollar down. Okay, so that's the kind of situation where you might quickly have a quick sell the spike very quickly, take some points, take your money, then look for a retrace, maybe a 50%, 61.8% Fibonacci retracement, and then trade the move out as well. And you know, the pair to look at is the US dollar Canadian dollar pair for trading the monthly GDP data. It's got a good spread, and it's very responsive to the data. Also, of course, remember the price of oil in this as well. Oil will be a factor. If oil's up, then Canadian dollar will be supported. If oil's down, then Canadian dollar will not be supported. Don't forget the coaching that we do here. If you deposit $1,500, you get a 1-hour coaching session with me one-to-one. $3,000, you get a 1-hour coaching session with me, and you get a trading follow-up review session. So that's really good in that I can see what you need, give you some homework to get on with, and then come back, 1 month, 2 months later, and see how did you get on? What did you find hard? What did you find easy? That's quite satisfying. It's really nice. I enjoy that, to see how people are doing and how they're getting on. And then the premium is exactly the same as the pro, but the extra thing is there's 1 week support. So you can have a week with me, sending me emails each day saying, I'm thinking of this, thinking of that. What are you looking at in the market? And I can send an email back. Again, not trading advice. It's all about education. Guys, don't forget tomorrow, and girls, of course, don't forget tomorrow, 1 o'clock to 2 o'clock GMT time, I will be doing an online trading workshop with myself, okay? So be aware of that. Oh, and also with the Brexit headlines, look at what the DUP are doing. If the DUP, I've just seen on the Reuters headline feed, no shift in DUP position after the call between Foster and May. So if the DUP suddenly support Theresa May's deal, big spike in the pound, that's something just to jump in for the pound. Again, not trading advice, but it's education, because DUP are holding the vote very much in the balance. If the DUP agree to support May, then the chances of May's deal getting voted and accepted are much higher. So look out for any DUP headlines. Tomorrow we'll be here 1 o'clock to 2 o'clock GMT time, and we got a workshop, and we'll be looking at putting some of these fundamental principles into a bit more detailed practice. Guys, I hope that's been helpful for you. Really enjoyed the session. I really enjoyed talking about the yield curve. I hope that's been helpful. And we've got a lot of Brexit headlines coming out on the Reuters feed here. So be aware of headline risks for the pound. Guys, thanks very much. You have a good day, and I look forward to seeing some of you guys tomorrow. Take care. Thanks for everything. Yeah, thank you, Raj. It's a pleasure as always. Really enjoying it, and really like I really like these times. Okay, guys, take care. Speak soon. Hope to see some of you tomorrow. Goodbye.